Welcome back to another edition of Intelligent Investment Today, the podcast dedicated to the art of value investment as laid down by the father of the craft, Benjamin Graham. Each episode we look at a different aspect of investment and consider how the rules laid down by Graham's books, The Intelligent Investor and Security Analysis deal with the issues faced by value investors today. In this episode we shall be considering another important topic from the world of equity investment. That is, the efficient markets hypothesis. The idea that proposes the market does a great job of assessing all the available data out there, and whatever a stock is selling at any point in time must be true and accurate. We look at the history of this hypothesis, consider if it has any merit, and discuss what Graham had to say about it. So, without further ado, let's get right on with it. The efficient markets hypothesis, or the idea that lots of people buying and selling stocks based on all available information will result in a stock trading at the price it deserves to, has been around in various guises for well over a century, but only really became popular as a concept in the 1960s. Its attraction as a theory is maybe that it is an inherently easy one to understand, and one that in some ways is simplistically logical, even if, upon contact with reality, it is prone to spontaneous combustion. Essentially, the theory states that if a new piece of information comes to light concerning a business, investors will vote about how this affects its valuation through the purchase or sale of stock, and this will thus determine a new and accurate valuation for that business based upon the revised situation. It supposes that all the minds active on the stock market will do a good job overall in assessing and processing all current information to hand to arrive at a fair valuation. Now, this last statement should set alarm bells ringing for any value investor out there worth their salt, for it is essentially the antithesis of the whole concept of value investment. For one thing, it is a statement that stocks will always be trading at their fair value. In other words, there are never going to be any bargains out there. So, if the theory holds true, then it puts us out of business. So where does the theory fall down? The failure of the theory can be summarised in just two words: human behaviour. The theory rests on the assumption that all actors in the market making the decision to buy or sell shares are both competent and rational, and we know this not to be true. Of all the people you know who are active in the stock market, can it be said of are trained and competent to do so? The typical investor in the street is often unable to distinguish his arse from his elbow, so what chance does he or she have when it comes to processing complex information that may alter the prospects for a business? And we must not forget that the theory supposes that the judgment of the market must be accurate, as there are so many minds independently arriving at what the stock should be trading at. Of course, how much truly independent thought is going into this is questionable. If Apple announce a big drop in profits, how many of the great body of investors out there are actually calculating how this should reflect in the stock price? The fact is that a handful of institutional investors may well do the number crunching, but the great body of investors who we are relying upon to create a sort of investment superbrain for this theory to work are simply following the reaction of the market or their own instincts. The point is that investors out there are not working as independent arbitrators of value, but rather as sheep following the herd. And this is where human behaviour comes into the equation. To work, the theory relies on dispassionate judgment, but humans are very poor at leaving their emotions by the door. They are far too prone to panic and loss of confidence, and this throws a massive spanner in the works. Even investors who know what they're doing and are skilled at picking the most promising stocks are liable to react when the stock market throws a wobbly. These investors will likely not be selling because they have rationally digested the new information to hand, which is what the theory relies on, but they will be simply selling because they have joined in with the mass hysteria that has engulfed the market as a whole. They will be following the crowd who are convinced the stock is heading to zero. As well as the propensity for investors to follow the crowd rather than independently establish how the new information affects the value of their stock, the way that financial institutions operate also plays a huge role in why the efficient market theory falls down. The reasons fund managers exit equity positions is not always tied to their opinion of a stock's prospects. Fund managers might be forced to sell what they would rather keep hold of for a number of reasons. Redemptions, or customers withdrawing their money from the fund, may force them to liquidate stock they believe is underpriced. Likewise, there are plenty of other reasons not related to the fund manager's opinion of a business why they might sell a promising stock. This might be to stay within the rules of their own fund. For instance, a stock that has done particularly well might breach a particular market capitalization range or percentage of a portfolio and need rebalancing, and no matter how far the manager may feel a stock has to run, they must sell. They may wish to lock in gains for a year to help guarantee certain targets are met, or be forced to sell if a stock falls out of a particular index that a fund is tracking. All of these things once again mean that players in the market, in this instance ones that control a huge body of stocks, are buying and selling not on the basis of the new information that has hit them, but on other arbitrary factors that are not concerned with the true valuation of the business. So individual investors who are acting on instinct rather than on information, and professional fund managers who are selling because they must sell rather than because they want to, means that what we are left with is not a stock market that has based its valuation on all the available facts, but with a stock market that is totally screwed up and whose valuation has been arrived at through panic and frustration rather than considered analysis. The firmest proponents of the efficient markets hypothesis, of course, will not have any of this. So how do they explain away the likes of Warren Buffett, Ray Dalio and Kai Icahn, amongst others, value investors who have made a living from picking undervalued stock, investors who have for decades made a mockery of their theory? Well, they claim that statistically there must be people who, through sheer good luck alone, beat the market. I'll leave that thought with you, as I'm not sure I need to defend Warren Buffett and all on this score. So what did Graham have to say specifically on the theory? It must be said that the theory could plausibly have been truer in his day than it is today. During Graham's time as an investor, the stock market was not as open to all as it is today. This meant that most investors were likely to either be professionally trained or, as all trades had to go through physical brokerage houses, have access to a professional gatekeeper. The same cannot be said today, of course. The vast majority of trades are made remotely online without the need to ever consult someone who has the faintest idea about stocks. But the false narrative that you sometimes hear is that Graham believed in the theory because value investing would not be possible without it. The argument normally goes along the lines that in order for value investors to make money, the market eventually must become efficient. But this, of course, is not what the theory actually says. It states that the market should always be efficient, not that efficiency will return at some unknown point in the future. They also do their level best to try and find quotes where Graham has said something that could in some way be construed as backing their theory. I called someone out for doing exactly this in an edition of the Financial Times published in May 2020, whereby a proponent of the theory quoted Graham as saying something mildly favourable about the theory, but then conveniently left out the end of the quotation. I pointed out to readers the omission which completely destroyed the point he was trying to make. So just beware of those who claim that Graham was on the side of the efficient markets school of thought. Perhaps the most compelling evidence that Graham was not a believer in the hypothesis is demonstrated by his analogy of Mr. Market. Mr. Market, remember, represents the market as a whole, and his decision on what stock should be bought or sold relies to a large degree on what side of the bed he got out of that morning. He is not rationally and dispassionately weighing up that morning's financial news. Mr. Market cannot live alongside the efficient markets hypothesis. One of them, by definition, has to be wrong, and I know which side of the fence I'm sitting on. So, to summarise, I think I've made it perfectly clear already what I think of the efficient markets hypothesis. I find it hard to believe that anyone with any understanding of the basic principles of value investment could imagine a world in which the hypothesis could work. For it to function, we would require every investor participating in the market to have a professional level of understanding to interpret the various complex flows of financial news and data and how to compute how this impacts on a company's stock price. We also require individuals to be totally emotionally rational all of the time and not be swayed by the sort of mass hysteria that affects the market at regular intervals. But that's not enough. We would also require the fund industry to buy and sell only on the basis of what should be bought and sold on value grounds, rather than to meet customer redemptions and other arbitrary fund rules. I think everyone knows not one of these requirements are ever going to be met, and the stock market is therefore never going to be efficient. Ladies and gentlemen, that is all for today. I hope you've enjoyed the episode and it adds one more brick in the wall to your goal of becoming a better value investor. Please do consider adding to playlist in order that you need never miss a future episode. I'm David Coombs. This has been Intelligent Investment Today. Until next time, take care and happy investing.